What if I told you that the whole concept of working until you're 65 years old is actually like a completely optional financial choice?
Yeah, it's wild to think about because it goes against everything we're taught.
Right. Today we're doing a deep dive into a fascinating stack of notes that basically argues your ultimate retirement isn't an age at all. It's an equation.
Exactly, an equation.
And for some people, that equation actually triggers in their 30s. You know, from the moment you get your very first allowance, or I don't know, that first minimum wage paycheck, you're taught this very specific, almost universal transaction.
You give up your time and you get money.
Exactly. It's the water we swim in. You trade your hours, your energy, your focus, and you get a salary.
It is entirely the default setting for how we structure our adult lives. I mean, the expectation is just that we sell our time to a company, constantly chasing that next promotion or, a cost of living increase until we're literally physically too old to keep up the exchange.
Yeah. But the sources we have for you today completely dismantle that default setting.
Yeah.
We are looking at the mechanics of this life-altering concept called FIRE, financial independence, retire early.
Right.
And we're going to decode the exact 5 asset classes that the source material says can permanently replace a traditional paycheck for you.
Okay, let's unpack this because the core shift here isn't just about, aggressively clipping coupons or skipping your morning coffee.
Oh, definitely not.
It's a fundamental rewiring of how you generate the cash you need to survive.
The core shift detailed in the text is moving entirely away from trading your hours for a salary and instead letting your capital generate cash flow.
Letting your money do the work.
Exactly. The ultimate goal here is to reach a point where your passive income, so the money generated by assets you actually own, exceeds your monthly living bills.
Wow.
And when that happens, you are, as the text brilliantly puts it, effectively rent-free from the traditional working world. You've successfully bought back your time, and every single Monday morning belongs entirely to you. Rent-free from the 9 to 5. I just love that phrasing because it paints such a vivid picture of liberation.
It really does.
But before we get into the actual ingredients, like the 5 asset classes you need to buy to make this happen, we have to establish the target.
Right, the math.
Yeah. I'm looking through these notes, and it says you need a mathematical bullseye, something called the rule of 25. And the math looks suspiciously simple on paper. Can you walk me through this reality check?
Sure. So the math is simple, but the implications are profound. To actually never work again, you have to define the exact cost of your lifestyle.
Okay.
Financial planners use this rule of 25 to determine the total portfolio size you need to safely retire. You figure out exactly what your annual living expenses are, and you just multiply that number by 25.
Got it.
The source gives a very clear example. If you determine that you need, say, $50,000 a year to live comfortably...
Like coding for housing, food, insurance, travel, all that.
Right. You multiply that $50,000 by 25. That means you need a $1.25 million portfolio.
Okay, so that $1.25 million is the finish line. But why 25? Like, where does that specific multiplier actually come from? I assume it's tied to how much money those assets are throwing off every year.
Yeah, exactly. The mechanism behind the multiplier is tied to an expected safe withdrawal rate. Across the 5 asset classes we're going to discuss, the target is to maintain a modest 4% average yield.
Just 4%.
Right. If you have a $1.25 million portfolio and it yields 4% annually, that generates exactly $50,000 a year in passive cash flow.
Oh, I see.
You are living purely off the yield, theoretically never draining the core $1.25 million.
Okay, I look at it like this. Imagine building this massive, perfectly engineered solar battery grid in your backyard.
Okay, I like that.
You never actually drain the core battery itself. The battery is so large and so efficient that you are just powering your entire life purely on the 4% of excess charge it naturally generates every day from the sun.
That's a great way to put it.
The battery stays at 1.25 million, and you just skim the excess charge to buy your groceries.
That is an excellent way to visualize the mechanism. The principal investment is the battery, and the 4% yield is the excess charge.
But I mean, I have to push back here because I know what you're thinking listening to this. Wait, a $1.25 million portfolio sounds incredibly intimidating.
Oh, absolutely.
For the average person, saving $1 million from a standard salary just feels impossible. Is the assumption in these sources that someone just slowly, painfully saves their way up to $1 million in a standard checking account?
What's fascinating here is how this math completely reframes our relationship with money. You are absolutely not just stuffing cash under a mattress or, in a zero-interest savings account until you hit 1.25 million.
Right, because that would take forever.
It would. It's no longer about hoarding a giant pile of static cash to slowly spend down until you die. It is about building an ecosystem. You're buying assets that grow and compound over time.
So the portfolio itself does the heavy lifting for you.
Precisely. You reinvest the early yields, letting the money multiply, to eventually reach that critical mass where the 4% excess charge covers your life. You are building an engine, piece by piece.
Okay, let's talk about the specific parts of that engine then.
Yeah.
Now that we have the 1.25 million target, how do we actually construct this massive solar battery?
Right, the assets.
Yeah. The source material breaks down 5 asset classes, and the first 2 are really the heavy hitters for generating that regular beating heart cash flow. Dividend-paying stocks and real estate.
A big 2.
Let's start with dividends, because in my head, investing is just buying a stock at $10 and praying the price goes up to $20. Why focus on dividends instead?
So the text draws a hard line between capital appreciation, which is what you just described, hoping the stock price goes up, and dividend investing.
Okay.
Dividend investing focuses on companies that distribute a portion of their actual realized profits back to the shareholders on a regular basis, usually every quarter.
Oh, so actual cash in hand.
Yes. Think about a massive mature company, like a household brand. They don't need to build 100 new factories every year because they already dominate the market.
Right.
So instead of hoarding their profits, they reward their investors by giving them a cut of the cash.
It's almost like getting a tiny royalty check.
Yeah.
If I own a dividend-paying stock in a company that makes, like, toothpaste,
Sure, toothpaste.
every single time someone in a grocery store buys a tube of that toothpaste, a microscopic fraction of that profit eventually makes its way into my bank account as a cash distribution.
That's exactly how it works.
And the text specifically highlights something called dividend aristocrats. These are blue-chip companies that haven't just paid dividends, they have actively increased their payouts for 25 consecutive years or more.
The mechanism driving the focus on aristocrats is predictability.
Predictability, right.
Because if you're replacing a reliable 9-to-5 paycheck, you need a highly predictable income stream. A company that has managed to increase its dividend payout every single year for over 2.5 decades.
Through massive recessions, housing market crashes, global crises.
Exactly. It demonstrates a very stable, resilient cash flow engine of its own.
But, and I'm going to play devil's advocate here, the source text includes a major warning. It says payouts are never guaranteed.
No, they aren't.
Companies can and do cut their dividends when they get into financial trouble. If an aristocrat can just slash its dividend the second the economy gets rocky, isn't relying on corporate profits for your literal grocery money a massive gamble?
It is a profound risk.
I mean, replacing a guaranteed salary with a non-guaranteed dividend feels incredibly risky.
It is, and that vulnerability is exactly why the source text emphasizes that you cannot rely on just one asset class. If you only own corporate stocks, your early retirement is highly exposed to corporate economic downturns. We need something that balances out that corporate risk.
Which brings us to the next one.
Right. This introduces the second core asset class, real estate. Real estate is fundamentally different from a corporate stock because it leverages a basic, inescapable human need: shelter.
Yet, no matter what the stock market is doing, people always need a place to sleep.
Always.
The text breaks real estate down into 2 paths. The first is physical property. You buy a house or an apartment, and you collect monthly rent. And the mechanics here seem incredibly powerful because of the dual force of leverage and inflation.
Let's explore how inflation works in the investor's favor here.
Yeah, please.
When you buy a physical property, you usually use a mortgage, right?
Yeah.
The bank's money to acquire the asset. Your mortgage payment is locked in at a fixed rate for 30 years.
So it never changes.
Right. But as inflation rises over the decades, the rent you charge your tenants goes up, and the underlying value of the property grows.
Why? Oh.
Your revenue increases, your asset value increases, but your biggest expense, that fixed monthly mortgage payment, stays exactly the same, becoming cheaper in real dollars over time.
It's a classic cash flow generator. But, like, reading through the friction of this, physical real estate comes with incredibly physical problems.
Maintenance.
Yeah, maintenance, tenant disputes, replacing a shattered water heater on a holiday weekend. For a lot of people, dealing with a flooded basement sounds less like early retirement and more like taking on a stressful second job as a property manager.
Which is why the alternative mentioned in the notes is so crucial for the FIRE movement REITs, or real estate investment trusts.
Right. Rates.
These are fascinating structural tools. They trade on the stock exchange just like regular stocks, so you can buy and sell them from your phone in seconds.
Oh, that's so much easier.
You get exposure to massive, large-scale real estate projects like shopping malls, massive apartment complexes, even data centers without ever having to fix a toilet.
I'm looking at the notes and REITs, and it says they have a major legal requirement that sets them apart from regular stocks. It mentions a 90% payout rule.
Yes.
Why would a company legally force itself to give away almost all of its cash? What is the structural advantage here?
It comes down to a deliberate tax structure. By law, a REIT must distribute at least 90% of its taxable income to its shareholders.
90%.
In exchange for doing this, the REIT avoids paying corporate income tax.
Ugh.
The tax burden is passed directly to the shareholder. For an investor trying to replace a paycheck, this legal structure forces the cash out of the company and straight into your pocket, creating an incredibly powerful automated dividend stream.
So we have dividends giving us a slice of corporate profits and real estate giving us a slice of the fundamental need for shelter.
Right.
But there's still a gaping hole in this strategy. What if a specific company goes bankrupt? Or what if a specific real estate sector, like commercial office space, suddenly crashes?
Which happens.
Even with these two heavy hitters, we are highly vulnerable if we pick the wrong individual assets. How does the source material suggest we build a safety net to prevent everything from collapsing?
This is the perfect transition to the third and fourth asset classes, which are designed entirely around diversification and stability. We need a way to smooth out the ride. First, we look at broad market and income ETFs. An ETF, or exchange-traded fund, is a financial mechanism that bundles hundreds, sometimes thousands, of individual assets into a single basket.
It's instant diversification.
Yeah.
You aren't trying to find the needle in the haystack, you just buy the entire haystack.
Exactly.
The text outlines two distinct paths you can take with ETFs to replace your paycheck. The first path is buying a broad index fund that tracks the entire S&P 500, the 500 largest companies in the U.S.
Right.
With this path, you use a systematic withdrawal strategy. You apply that 4% rule we talked about, gently selling off a tiny sliver of your massive growing basket over time, assuming the overall market will always trend upward over the long haul.
And the second path is utilizing dedicated income ETFs. These are funds specifically designed to maximize monthly payouts rather than focusing on the overall basket growing in value.
Like what?
Well, the text mentions high-yield bond ETFs and covered call ETFs.
Let's pause on that for a second, because covered call ETF sounds like intense Wall Street jargon. The notes say these funds use option strategies to generate high, immediate cash flow. What actually is a covered call? How does it generate cash out of thin air?
Let's break down the logic of a covered call without the jargon.
Please.
Imagine you own a house worth $500,000. I come to you and say, I will give you $1,000 in cash today if you sign a contract promising to sell me this house for $550,000 anytime in the next year, regardless of what the market does.
Okay, I take you $1,000.
Exactly. You take my $1,000. That is the premium. A covered call ETF does this with stocks. They own a basket of stocks, and they constantly sell contracts to other investors, giving them the right to buy those stocks at a set price.
I see.
In exchange, the ETF collects millions in premiums up front, and they pass that raw cash directly to you, the shareholder.
Okay, so that forces immediate cash into your pocket by selling future upside. That makes perfect sense.
Yeah.
Now, the notes also talk about bonds as the fourth class. Let's demystify these, because bonds notoriously sound boring, but the text frames them as absolutely crucial.
They are.
A bond is essentially just a loan, but instead of the bank loaning you money, you're loaning your money to a government or a large corporation.
Right.
In exchange for you loaning them your cash, they promise to pay you regular fixed interest payments, called coupons, and then they promise to return your original money in full when the loan period matures.
The source text uses a very specific, deliberate word for bonds: ballast.
Ballast.
In a ship, the ballast is the heavy weight placed low in the hull to provide stability in rough waters. Bonds typically offer much lower returns than stocks or real estate, but what they lack in growth, they make up for with incredible stability and legally guaranteed payout schedules.
I love that analogy. Bonds are the heavy lead keel of a sailboat. They absolutely will not make the boat sail any faster. In fact, if you have too many of them, they slow you down. But when a massive financial hurricane hits, that heavy lead keel is the exact thing that prevents your boat from capsizing. It keeps you upright.
That's the exact function.
But if I'm looking at this critically, if the whole goal is to reach that $1.25 million target, the rule of 25 as quickly as possible, so you can escape the 9 to 5, why drag our feet with the heavy keel? Shouldn't we entirely avoid low-return assets like bonds and just go all in on high-growth tech stocks until the day we retire?
This raises an important question about something financial planners call sequence of returns risk.
Sequence of returns.
Yes. It comes down to the psychological and mathematical reality of the moment you actually quit your job. Imagine the day you retire. You throw a party, you hand in your badge.
Best day of your life.
Right. Your salary stops completely. You lose that structural support. Now imagine the very next month, the stock market drops 30%, just like it did in 2008.
Oh, wow.
If you are 100% invested in stocks, your battery is shrinking rapidly, you're losing money on paper, and yet you still have to sell some of those stocks at a massive loss just to pay your electric bill.
Wow. If you are forced to sell assets while they're down 30%, you permanently destroy the compounding power of your portfolio. You're locking in the loss.
Precisely why the ballast is non-negotiable. That guaranteed payout schedule from bonds, knowing exactly when and how much cash is hitting your account, regardless of whether the stock market is crashing, is absolutely critical.
It provides a cash buffer.
Yes, so you don't have to sell your stocks at a loss.
Yeah.
It prevents panic. You need the heavy keel the moment you navigate into unpredictable waters.
The math isn't just about reaching the number. It's about engineering a system that lets you sleep at night once you get there.
Exactly.
Now, I want to pivot slightly because we've talked entirely about assets you buy with capital. You need money to buy stocks, REITs, ETFs, and bonds. But what if you are listening to this and you don't have massive amounts of cash to deploy right now?
It's a common hurdle.
The final asset class the text provides relies on a completely different kind of investment. It's the wildcard cash flow business assets.
This is where we move into alternative assets and private equity that generate direct revenue. The text gives a highly diverse list of examples.
Like what kind of businesses?
It ranges from digital assets like profitable blogs, YouTube channels, or building a software-as-a-service platform, all the way to physical cash businesses like running vending machine routes, managing car washes, or licensing your intellectual property.
Building a portfolio this way feels like engineering your own automated assembly line in your garage, rather than trying to buy shares in someone else's expensive, established factory.
That's a great comparison.
But the defining characteristic the notes highlight here is that this route requires heavy, upfront sweat equity. You are investing your time, your weekends, and your mental effort, rather than just deploying a lump sum of cash.
And the payoff for that intense sweat equity can be tremendous because you built the asset from the ground up. Once it is established, it can offer cash flow margins that absolutely dwarf traditional financial markets.
Really?
Oh, yeah. You aren't settling for a 4% yield on your capital. A successful digital business might be seeing a 40% or 50% margin on the revenue it generates.
Hold on, though. Heavy, upfront sweat equity, managing a car wash, constantly filming YouTube videos, or debugging a software platform, that sounds exactly like a job.
It does sound like one.
Doesn't building a software as a service company or physically restocking vending machines completely contradict the retire early part of FIRE? It sounds like you've just traded a comfortable corporate 9 to 5 for a brutal 24/7 entrepreneurial hustle.
If we connect this to the bigger picture, the text provides the critical distinction between being self-employed and owning a business asset. The key word the source uses is systemized.
Systemized.
Yes. The upfront creation is intensely labor-driven. You are the one restocking the machines initially, but the goal is to build an asset, not just create a frantic job for yourself. Once established, you must systemize it.
So you hire people.
Right. You hire dedicated operators to manage the car wash. You use inventory software to automate the vending route so a driver can run it. You build the software product so it runs on remote servers without your daily coding input.
Gotcha.
The transition is moving from continuous daily labor to the role of an owner. The system yields high margins, but your daily presence is no longer required to keep the lights on.
So you deploy the sweat equity early on to build the battery, and then you purposefully step back and let the automated system run the excess charge.
Exactly.
So what does this all mean? Let's bring all these mechanical parts together. We have the target, the rule of 25.
Yeah.
And we have the 5 components of the engine.
To synthesize the journey the text lays out, you are trying to safely generate a 4% yield to permanently replace your paycheck. You can engineer that engine using dividend stocks for mature corporate cash flow, real estate and REITs to leverage the human need for shelter, broad market ETFs for diversified growth, bonds for the crucial ballast and protection against sequence of returns risk, and systemized business assets to leverage your sweat equity into incredibly high margins.
They work dynamically together.
Yes. Where one class is vulnerable to inflation or market panic, the other is strong. Here's where it gets really interesting for you, listening to this. Escaping the 9 to 5 isn't just some pipe dream reserved for lottery winners, tech billionaires, or trust fund kids.
Not at all.
The sources map it out as a mechanical, achievable math equation. It is fundamentally about shifting your mindset from perpetually selling your time to strategically acquiring assets that buy your time back.
It transforms the abstract, often overwhelming desire for freedom into a concrete, solvable engineering problem. And engineering problems can be solved step by step.
They absolutely can. But as we wrap up this deep dive into the mechanics of FIRE, I want to leave you with a final thought to chew on.
This entire strategy relies heavily on the rule of 25, which requires calculating a very specific, static cost of living. $50,000 a year in our example.
Right. It assumes it stays relatively stable.
Exactly. But think about how fast the world is moving. What happens to these precise, mathematically perfect formulas if radical technological shifts in the next 2 decades, like advanced AI, robotics, or entirely new, cheap energy paradigms, completely change what we even consider a living expense?
That's a huge variable.
Or, on a deeply personal level, what if your definition of an ideal life dramatically evolves 20 years into your early retirement and suddenly you want to travel the world, and that battery simply isn't big enough? Does the math still hold up when the very nature of our expenses and our human desires changes?
It's a profound question.
It's something to seriously consider as you start building your engine. Until next time, keep diving deep.